Today we're going to look at 3 hacks you can use to pay off your mortgage early. Hey everyone, thanks for tuning in. I know with the economic uncertainty in the country right now, that paying off your mortgage may look like a pipe dream, but after this hardship is over, I can promise you, another one will come. Wouldn't you like to be mortgage free when that happens? Let's check these out. First, let's see how much money you give to the bank for the privilege of them lending you money. My average sales price last year was just under $150,000. So let's use that number as an example. On a $150,000 mortgage over 30 years at a 4% interest rate, your principal and interest payment will be $716. This doesn't take into account your homeowner's insurance, taxes, or other escrows, because those change based upon the property. But at this number, if you make the minimum payment for 30 years, you will have spent an extra $107,804 just in interest. Insane, right? That means that the $150,000 home you bought actually cost you north of $250,000. I know you're asking yourself, Chris, how do we escape this? Good question. First, extra principal payments. For my existing clients, you already know what I'm about to say because we had this conversation at the closing table. Take your monthly payment, in this example $716, divide it by 12, and that gives you $59 a month. Add that to your current payment to get your new monthly mortgage payment of $775. Making the small $59 a month extra payment will save you $16,540 in interest and pay off your loan 4 years earlier. Now, this isn't the only type of extra payment you can make. Tax returns, work bonuses, second job income, that stimulus money that the government just threw at you, all great ways to pay down your principal and to work towards being mortgage free. Number 2, don't buy the largest house that you can afford. If this is your first home purchase, it's likely not going to be your forever home purchase. The average person moves every 7 to 10 years, and that number shrinks even more for the first-time home buyers. Owning a home is a great way to begin to build wealth if done correctly. If you're just starting out, don't buy a home where the monthly payment is more than 25% of your take-home pay. If your family brings home $4,000 a month, you should try to keep your mortgage payment below $1,000 a month. This will allow you some flexibility to make extra principal payments in the future. Finally, number 3 is eliminate PMI. PMI is private mortgage insurance. This is insurance that the banks make you pay to insure them if they foreclose on your home. Crazy, right? It's almost like gap insurance for a car. If you default on your loan and the bank seizes your property, that insurance covers their loss that they take when they sell the home. Generally, PMI is only required if your loan value is more than 80%, meaning if you have at least 21% equity in your home, PMI goes away. In our example of a $150,000 loan, PMI is $88 a month. That's with an average credit score and debt to income ratio. It could be even more if you have worse credit. If you can eliminate PMI, you can use that extra $88 a month to pay down your principal in example 1. I really hope these tips help. Paying your mortgage off early may mean the difference between you retiring early and retiring at all. Question of the day. If you paid off your mortgage, what would you do with the extra money? Let me know in the comments below. Thanks for watching.